Okay, while others are logging on, we'll cover a few housekeeping tips here. As you can see, the housekeeping slide provides tips about connecting your audio, so hopefully you're able to get that done. However, if you have any technical issues now or throughout the presentation, please use the chat and our host will assist you. As you can see on the slide, we note that due to the large number of participants today, which is great, we will not be doing any live Q&A. So please email us with any questions. Our emails are right there on the slide there at the bottom. Also, you'll see them a couple other times, and we'll follow up afterwards to try to resolve the questions that you have. Also, for everybody that's registered for today's webinar, we'll be following up within a few days with a copy of the presentation slides and a copy of the recording. The session is being recorded. So with that, my name is Cindi Turoski. I am managing member of Bonadio Wealth Advisors, where we advise clients on their overall personal finances. As tax CPAs and certified financial professionals, our team provides high caliber tax and financial planning expertise that comes from our time and advanced training being focused solely on planning and consulting rather than managing money. And I also want to give Tony a chance to introduce himself.
My name is Tony Duffy. I'm the Managing Director of the Valuation Group within Bonadio and Company. We have a relatively small group of 7 or 8 staff. We perform business valuations for a variety of purposes. We're full-time valuation professionals now, reformed CPAs and tax preparers. We handle between 100 and 150 projects each year for a variety of purposes.
Thank you, Tony. So again, thank you for taking the time out today to join us for today's webinar. It's a crazy time. We do hope that you're all hanging in there okay and everyone's safe and healthy. Certainly there's a lot of webinars out there to take advantage of, so I'm glad to provide some content to fill your day. But we wanted to make you aware of some planning opportunities in the current environment. So I'll be speaking on the estate planning opportunities that are here during this crisis. And Tony will be speaking after that on business valuation considerations. For most, real estate values could decline. Interest rate on our savings accounts and bonds are on the decline. That part we certainly don't like, none of it. But among all that, there's certainly some good news. So I guess the glass half full perspective. Those deflated values, those low interest rates, when you combine them with the fact that we have a high federal gift and estate exclusion, there's no New York gift tax. So if you're a New York resident, you get to benefit from that. You just have to live 3 years for the asset to be effectively removed from your estate after you gift it. We still have an arsenal of techniques still available. If there's a change in administration, there's a risk that those could be restricted or some eliminated. That's been discussed over the years, proposed. Nothing's come through. So as far as we have right now, we have that whole arsenal of techniques to work with. Similarly, with valuation discounts, they're all still fully enforced. There's been similar proposals and discussions about limiting them as well. So it hasn't happened, so now's the time. So we have a perfect mix creating planning opportunities for those with the means. Some of the, excuse me, sorry. Some of the planning opportunities that I'll be discussing is succession planning, gifting, intra-family loans, and Roth IRA conversions. But before I go into those, I just want, excuse me, there's more to the story than just the techniques. We think of the techniques as a toolbox. Anybody can pull out a technique and use it, but you want to make sure the technique fits the situation of that particular client. And you know, you think of a toolbox. You wouldn't grab a wrench to do the job that is needed, that a screwdriver is needed for, and this is all very similar. So as you go about doing any planning, don't do it in a vacuum. step back and consider the other aspects of the situation. So with that, it could be certainly the person's cash position and the cash flow needs. It's possible that they might need something back from the technique. You know, they need some kind of cash flow coming back in, or there's certain kinds of trusts and strategies where we have the person pay the tax to the trust, but they might not have the cash wherewithal to do that. So we have to understand that part of their situation to know what might make the most sense for them. Similarly, we want to make sure that their financial security is, we understand what they need to keep for themselves. You can't go gifting it all away, gifting too much away. What is excess? I remember a situation where a partner came in and you know, just gave me their balance sheet and said, what can we do for them? And I had a blast coming up with combining all these different strategies and techniques. But then I asked them what the living expenses, what was the person's lifestyle, what was their cash needs in a year? And it was a big number, much higher than I assumed. I have clients that spend well over $1 million a year. So I would have left them destitute. So that's an important factor is, you know, can they afford to gift? And what's enough for one person might not be enough for somebody else. They have to also understand their income tax and their gift and estate tax situation, so we understand how those implications might impact them. That might dictate a different strategy. And if they're planning to transfer wealth to heirs, we have to understand their heirs' financial and income tax situation, because that adds to the picture that we want to balance. And if it involves a business, we need to make sure that the strategy works for the business as well from a cash and tax standpoint. No sense in going about a strategy if it's not feasible for the business as well. So the first topic is succession planning. That's often something on the to-do list for business owners. It doesn't have a tax deadline like a tax return does, so it often seems like something that is not urgent to get to. It's not time sensitive. But hopefully this opportunity here will put a little more urgency to it. But the first step is for the business owner to understand their options before that, so that they can understand what they need from the business in order to satisfy their personal financial needs. What they need from the business might dictate what the strategies are and what direction to go in with the planning. We also want to, if they, after doing that, realize, okay, I want to, and I now know I can afford to, gift the business interest to the heirs. They may have a child working in the business, or sell it to them at the lowest value possible. They want something back from it, but it doesn't need to be the maximum value. Now may be the time for them to implement a strategy that fits both their personal and the business's situation. And now, again, business valuations, values might be down as of March 31st and likely much lower than they were at December 31st. And Tony will speak more on that later. Interest rates are low if they find they want to take back a note, and they like the idea of the rate on the note being as low as possible. Opportune time with that as well. The current environment really gives us gifting leverage. It was already, with the federal exemption, we already had gifting leverage, but it's enhanced even more so now. So for those that have a federal taxable estate, it's a great opportunity to lock in the temporary high federal exclusion that we have. It's $11.58 million right now, but it's set to sunset automatically December 31st, 2025, without any governmental active, no active Congress. Nobody has to take any action to make it happen. But it very well could go down sooner. You think about it, we have two presidential elections during that time period, one coming up, and there's been a high level of federal spending during this crisis. So what are the chances that it'll come down sooner? And in the meantime, while we have this high federal exclusion, it's an opportunity to transfer more units for the same gift value and let the rebound happen in the hands of your heirs. For those that have a state, taxable estate, but not federal, for instance, New York's state exemption exclusion is $5.85 million. You'd have to check your state's rules. But they could possibly make the same gift that they were planning to make, but at a reduced value, which could preserve more of their federal exclusion. New York doesn't have a gift tax, So it's another chance possibly to save New York estate tax. You just have to live 3 years from the time of the gift. So add that to the federal estate tax savings. That can be pretty powerful. So how might you gift? You can do outright gifts. Certainly that's the simplest. You gift assets directly to your heirs for them to do whatever they want with. There's risk to it, but there's certainly a lot of benefits to it. You can gift in trust. There's many tax and non-tax reasons to gift to heirs in trust rather than gifting to them outright. Some non-tax reasons might be you don't want them to kind of sudden wealth syndrome where they get too much all at once, or, you want to control. You might want to stagger it. You might want to entrust for their lifetime, and often with the entrust for their lifetimes, asset protection purposes, we say creditors and predators, divorces, lawsuits, etc., bankruptcy. So that might be a reason to gift in trust. And either way, lifetime gifts, the nice benefit is getting to see them enjoy it. You get to see the benefits of the gift that you've made. So if you were to gift in trust, that would have to be an irrevocable trust. A revocable trust, a living trust, does not remove the asset from your estate. So you would gift it into an irrevocable trust. And the deflated values that we have right now reduce the gift tax impact when you transfer the assets to the trust, or it might give you the chance to gift more units into the trust for the same value. And the trust can be structured to pay the income tax itself as a standalone taxpayer. We call that a non-grantor trust. Or it can be structured for you as the grantor to pay the tax. We call that a grantor trust. If you pay the tax instead of the trust is left intact, compound free of taxes. And the estate taxes or the income taxes that you pay further reduce your estate without any additional transfer tax. It's like an additional gift to your heirs free of gift tax. We call that the estate burn. And that's a potential advantage that you wouldn't have if you did an outright gift. If you did an outright gift, certainly now the assets in the hands of your heirs, and they would pay any resulting income tax on any interest or dividends that the asset earns from that point forward. But again, we still have to balance, can you afford to pay that tax on behalf of the trust if you chose to structure it that way? You need to make sure you plan your cash flow and maintain a good cash position. So that might not fit your situation. And a gift into a trust removes future appreciation from your estate. That's actually the case with all gifts. Another advantage of doing lifetime gifts. Let that appreciation, and you think about the appreciation you could have from this point forward with these deflated values, that rebound to get back to normal, let alone any future appreciation beyond that, to happen outside of your estate would avoid compounding your estate further. You also can do a sale to an potentially defective grantor trust. That's a strategy that can work very well under this current environment. We talked about a gift to an irrevocable trust. We did the whole transfer into the trust was fully a gift. But let's say you didn't want to do that. You wanted to sell some of the assets to the trust and take back a note. Maybe that fits your situation. There still needs to be some gift portion into the trust. That's usually, rule of thumb, is 10% of the value going into the trust. So the fact that the values are deflated right now would reduce the gift tax impact of that portion that has to be transferred into the trust as a gift. And the low interest rate on the note that we would currently have reduces the interest the trust would have to pay you if that's an objective. So that would be less coming back into your estate with the lower interest and more of the trust left intact to compound. So this is an estate freeze technique because you're not, for the sale portion, you're not using your exclusion for that. And any balance of the note and any unspent payments you've already collected would still be in your estate. But it can be a great estate freeze technique and be even more effective in this current environment. And again, remove future appreciation from your estate. We also have a strategy. There's also a technique called a zeroed out grantor retained annuity trust. That's a GRAT in lingo terms. In that case, you make a gift to the GRAT, a gift into the trust. The trust pays you back an annual annuity payment that zeroes out the gift tax implications. What those payments would be the principal that you transferred into the trust plus an interest component. And that interest component is determined in the month that you fund the trust. That determines what rate this will be used to pay you the interest. And then at the end of the trust term, the assets pass to your heirs. Any growth in excess of whatever the interest rate is at the time, and that's what we're talking about, interest rates are just so low. In April, in this month, the rate is 1.2%. Any growth in excess of that passes to your heirs free of transfer tax. So it seems like it should be pretty easy to hurdle 1.2%. The deflated values and the low interest rates increase that likelihood that appreciation will pass to your heirs tax-free. Both the rebound, like I talked about before, of the current deflated values, let alone just normal appreciation, could be a pretty powerful wealth transfer strategy here. And it's an estate freeze technique because you do have payments coming back to you. So it freezes the value for estate tax purposes. Now, it doesn't have to be, we call this a zeroed out grant to retain a zeroed out GRAT because, like I said, we're zeroing it out so that there is no gift tax implication. There is such thing as a GRAT that doesn't pay you back as much. In that case, there's more remainder left for your heirs and therefore more of a gift. But we call this a bet to live technique, where if you die during the term, some portion of the assets are included back in your estate. So we want to make sure that, it's a high-risk environment we're in right now, and you want to make sure you've used, with this high federal exclusion, you want to try to use as much of it as possible if you have a federally taxable estate. You want to be sure you're using it. Another great strategy right now that's timely is a charitable lead annuity trust. With this type of technique, you make a gift to the trust. The trust pays charity an annual payment, not you or your family, and the assets pass to your heirs at the end of the term. Now, this could be charitable contributions that you're typically making every year. It doesn't have to be extra charitable contributions. But what this does is it leverages those annual charitable contributions you're already making to create a discount for the remainder passing to your heirs. And the reason is that your heirs aren't getting it right away. They have to wait. They have to wait until the end of the trust term. And in the meantime, those assets are being used to fund those charitable contributions, those charitable gifts. So that creates a discount for gift tax purposes. When you add that to the fact that the values are so deflated right now, that really reduces the gift tax impact even further. And same with these low interest rates. And also these lower, similar to the GRAT that I talked about in the prior slide, these low interest rates create an opportunity for more wealth, the remainder to pass to heirs transfer tax-free, gift tax-free, because anything more than that 1.2% or so that it earns passes to your heirs without any gift tax implications. Pretty powerful. Something I didn't include on the slide is this is another great strategy in light of the fact that a lot of people are not getting to itemize on their income tax return. They don't have enough to get over the threshold to make it worth itemizing over taking the standard deduction. So therefore, any charitable contributions that they're making, they're not getting an extra income tax benefit from making those. Can't deduct them from deducting those. So with this strategy, another side benefit to it in this current income tax situation is that whatever assets you carve out of your portfolio to put into this trust, the interest and dividends those assets would have earned in your hands are now removed from your income tax return and carved out into this trust. And as that income is earned in the trust, and the trust gets those interest and dividends that it used to get, those charitable contributions that the trust makes can offset them. So there is a benefit reducing, there can be a zero tax impact of those interest and dividends now by removing them and putting them over into this trust. And there's no AGI limit on those charitable contributions, so it can be 100% against the interest and dividends. So that's not something you get on your personal tax return. So this can be a great strategy from a couple of different angles. Another one is interfamily loans. In this case, you make loans to your heirs at some minimum interest rate. We call that the AFR rate. That's the rate that the IRS says has to be charged, the minimum that has to be charged on the loan for it to avoid any gift tax implications. And those rates are really low right now. They're lower also than they can ever get at a bank. So for example, April 2020 rates, AFR rates, on a short-term loan of 3 years or less, 0.91%. Midterm loan of more than 3 years up to 9 years is 0.99%. And a long-term loan of more than 9 years is 1.43%. So imagine if you held a mortgage for your child and you gave them 1.43%, nice. That's a lot lower than they can get at the banks. Even though the banks have nice low rates, that's even lower. And also they don't have the same closing costs. You know, you do have some costs involved. You have to actually have a mortgage written up, but it's a lot lower than it's a lot less than would be incurred if your child went to the bank. If you did do that and you decided to hold the mortgage for your child to get a home, that mortgage has to be secured by their home so that your child can deduct the interest they pay you as mortgage interest. You can also refinance the mortgage. If they have a bank mortgage now, you can choose to give them the money to pay off that mortgage and structure it as a mortgage that you hold for them, again, secured by their home. You can negotiate a lower rate. Say you had prior interfamily loans, you can negotiate a lower rate. Maybe there's got to be a give on the other side, maybe shorten the time period, the term of the loan, but you might be able to bring existing loans down to a lower interest rate to further help out your heirs, your family. And it is a great way to help out a family member. And again, this goes to your personal financial situation. You have to be able to afford receiving that low an interest rate on your money, so to speak. So again, always more to the story. Another idea is annual exclusion gifts. You can do that every year anyways, but now might be a great opportunity to do it a different way possibly. What those are is it's a gift tax freebie, we like to say, where everybody can gift up to $15,000 to anybody they want. And a husband, wife, a married couple can gift up to $30,000 to anybody they want. So you can think of how effective at transferring wealth that could be over time, and certainly all the future appreciation that goes with it. So let's say you have 3 kids. They're married. You can choose, if you're comfortable doing so, to also gift to their spouses. Let's say they have kids, you can gift to all your grandchildren. So imagine tallying that up at how powerful that can be over time. That's a great way to reduce your estate or keep it from growing, like I said, over time. But for those with federal taxable estates, one way to typically people do this in cash, but maybe consider making those 2020 annual exclusion gifts in shares of publicly traded stock to leverage the fact that those values are so deflated. And, you know, once in the hands of your family, your heirs, let the rebound happen in their hands. If you don't have a federal taxable estate, maybe you just have a state taxable estate, we have to weigh up the income tax considerations to your heirs, because anytime you make a lifetime gift, we say that has carryover basis. The basis to your heirs is the basis that you had in your hands. So we always have to weigh up the income tax considerations that your heirs would have to pay, the capital gains, with the estate tax savings. It's a slam dunk when you have a federal taxable estate, but it has to be looked at closer when you have you don't have a federal taxable estate. And the last strategy or technique I'm going to talk about is Roth IRA conversions. These can be very advantageous from an income tax and a wealth transfer tax purposes. So if you know that you don't need this wealth for your lifetime, and it's just going to be unspent, that's where it can really have some value. So with Roth IRAs, qualified withdrawals are tax-free. But if you had a traditional IRA, and of course the money inside there hasn't been taxed, IRS wants their share of the tax. That was not meant to always be tax-free. So if you do a conversion, whether it's full or partial, of a traditional IRA to convert it into being a Roth IRA, that triggers taxation of the portion in your traditional IRA that hasn't yet been taxed. So at the time of conversion, there's a taxable event. But when we look at the fact that IRA values are depressed right now, that certainly can reduce the income tax due on the conversion and let that rebound happen inside the tax-free Roth IRA. So again, opportunity with these deflated values. For some, 2020 taxable income might also be lower. So from that standpoint, it could also be good timing to consider it. And there's more, you have to look at the whole picture on that to make sure it makes sense for your situation. You have to have cash outside the IRA to pay the conversion tax. Otherwise, it's usually not advantageous. There's more, but it's worth considering. For younger people, it often makes sense for income tax purposes, and the fact that in the future, when they turn now age 72 under the Secure Act, they will not have to take required minimum distributions with a Roth IRA like they would if they had a traditional IRA. And again, with those that have excess wealth, they can be an effective vehicle for passing wealth to heirs. For one, with a Roth IRA, there's no required minimum distributions over your lifetime. It allows the Roth IRA to compound further in a tax-free wrapper. Those tax-free distributions continue on to your heirs once they inherit the Roth IRA. They do have to start taking required minimum distributions once they inherit it, but those distributions are tax-free. And also, this is especially advantageous under the Secure Act. Under the Secure Act, most beneficiaries are required to fully distribute the retirement account within 10 years. And if you think of a traditional IRA where those distributions are taxable, that can be a pretty, say you have $1 million in that traditional IRA, that can create significant tax consequences to your heirs over such a short time period. You don't get the lifetime stretch that we used to have. So if it were in a Roth IRA, they still have to take it out over 10 years, but it's tax-free. So they can let it sit there for the full 10 years, and on the last day, second to last day of the 10th year, take it out. And in that time period, it will continue to grow tax-free. If you have a taxable estate, by paying the conversion tax, you further reduce your taxable estate. And now you are paying tax on something that your heirs would have otherwise have inherited and had to have paid income tax on as they took out withdrawals, as they took distributions. So by you paying the tax for your heirs, it's like an additional gift to them without gift tax. You're freezing its value for income tax purposes because from the point of conversion forward, there's no longer any income tax as long as the distributions are qualified. So that is why this can be pretty powerful from a wealth transfer standpoint when you have a taxable estate. So with that, I want to turn this over to Tony Duffy to talk about some valuation considerations. Thank you.
Thank you, Cindy. Before I get going here, too, we have this open to a wide variety of participants. As we received a list shortly before we started here, and we have about 1/3 are business owners, about 1/3 are nonprofit type entities. There's healthcare charities, foundations, a lot of different organizations such as those. We also have other advisors, lawyers, insurance people, financial planners. We have a lot of different people on the line. Try to keep this as applicable as possible for everybody to take something away. If you move that next Cindy. So what we're talking about is the valuation for closely held companies, the valuation for anything that is not traded publicly, closely held companies. For the most part, that is what we at Bonadio deal with on a day-to-day basis. But we find ourselves right now in a predicament that there is just no history for. Financial studies, financial theories, almost all of those go back and study all the events back to 1932, back to the Depression. Seldom does anybody in modern portfolio or valuation theory go farther back than 1932. Therefore, a pandemic that we're experiencing right now has not occurred during the past 90 years. So there isn't a lot of history as to how the markets will react, how valuation reacts, and there is just a great deal of uncertainty. And we receive, just like I think everybody, barraged by emails the past 3 to 4 weeks from a variety of sources. On a daily basis, situations seem to be changing. So, on a broad base, valuation concepts. Valuation is based upon the situation that is known or knowable at the valuation date. This is very important. The valuation date, not anything subsequent. Subsequent events are not considered in a business valuation, in an asset appraisal. It is a very basic underpinning of any appraisal standards. Now, valuation is also a forward-looking exercise. The valuation of an asset is based upon the future returns for that asset. Usually, we're able to look back at history, find a stable and repeating future income stream, and discount that income stream at a risk-adjusted discount rate. Now, all different businesses have different risks, so each individual business has its own discount rate based upon the nature of that specific business. Now, it's always been this way that we have been able to do this. The basic indicated values that we get through this process for closely held companies, we also have a rather significant lack of marketability. Closely held stock is not a liquid asset. It's not like public stock where you can sell it and get cash in 3 days. There is a substantially longer sales cycle, and there is a discount associated with that. Now, depending on what we're valuing, when we value a minority interest in a closely held business, there's even a further discount to the value of the business as a whole. Now, all of these items, future income stream, the risk rate associated with that income stream, and marketability, all of these elements right now are highly speculative, and for the most part, we are not sure, 100% sure, about these 3 items at this time. Next slide, Cindy. So the valuation dates, dealing with each of these elements that we're uncertain about. the valuation date is extremely important. If we are valuing a company today that as of 12/31, we cannot adjust that value for what we know has occurred through today. Any attempt to do so would render the report to be in conflict with basic appraisal standards. And just like a stock portfolio was worth one thing on December 31st and something different on March 31st, closely held businesses work the same way. Let's see, the subsequent events are disclosed in the valuation report, but part of that disclosure states that we have not adjusted our valuation conclusion for the subsequent events. So it's as if we've been parachuted back to the date of valuation, and we only use what is known or knowable at that time. This has many repercussions, gifts that have already been made in 2019 that we're performing the final valuations now, but also M&A activity where a transaction was started in 2019 and was started with certain assumptions at an expected sales price, but has not closed. In that situation, how that transaction finalizes, we'll leave that up to the lawyers, but there is the possibility that the transaction would fall through, both because of all of the events that have transpired, the uncertainties that exist. Right now, there may also be a lack of financing support. The banks might not be willing to finance the transaction. And this goes into litigation matters as well, where litigation began in 2019. It hasn't been finalized as yet. When the value of a closely held business is subject to the litigation, this is an unprecedented time, and what is fair in each situation as to how to handle that. But a valuation as of March 31st would use totally different sets of assumptions. They would result in different conclusions of value, and those values are nothing like what we would get as of December 31st in almost all situations. This date is very critical. Send. The income streams, and this is the most significant change in the situation. There's a change in marketability, there's a change in risk and discount rates, but the income stream change, the expectations that have changed during the past 3 months are the most significant effect on value. 2020, the expected profit a business might have is now totally different just 3 months later through no fault of the business owner themselves. We typically try to find ongoing income streams based upon the company's historical financials. Well, today, those historical performance indicators, what has happened in the past, is generally not indicative of what will happen in future operations. We have to develop new expectations independent of what has happened in the past. Now, we've started this in a couple of occasions. There's a great deal more input we need to have from clients. The clients have to go through a process themselves of starting to understand what the short-term impact of everything that we're going through has on their business. And this could be helpful to many businesses, not just for us, but for themselves, so that they understand exactly where are they headed for 2020, for 2021. And again, the change in this expectation for future income streams is by far the most significant change that has an effect on valuation conclusions. Cindy, next one. Now, there's discount rates. So the discount rates are the mathematical inversion of a required rate of return, so that a business, and 3 businesses each make $100,000. Traditionally, if the business was real estate, the $100,000 might indicate that the full value is $1 million. A 10% discount rate, and the asset is worth 10 times the annual cash flow. An insurance agency has more risk, and it might only be worth $600,000 or $700,000 because the discount rate might be 14 to 17%. And then a construction company also making $100,000 might only be worth $500,000 because its risks are even greater than the insurance agency or the real estate operation. And therefore, a 20% discount rate would be. So that these are long-term rates that have been established over many decades. So these are not rates based upon a spot, a day, a month. These are rates that have been developed, and they're expected long-term rates of return. Long-term. Now, while our short-term risk, we think it might be, 3 months or 6 months and maybe 12 or 18 months to recover. That is a relatively short period of time as far as the long-term discount rates. Long-term discount rates are usually referring to 10 to 20 year looking out. So there's some effect on the discount rates. There is increased risk. There's especially increased industry risk and a wide range of changes in industry risk. But this risk change does not have as significant effect on the value as the change in actual income or cash flow does. Every day we're getting new information from a variety of sources, and let's say big valuations, public companies, and there's a lot of attention to the adjusted risk rates for public companies. But I maintain that until somebody can figure out what future cash flows are going to be, the risk rate is less of an effect, has less of an effect on the valuation conclusion. We're using the best information we have right now, but because this is a new situation, unlike anything that we have experienced in the past 90 years, we don't have a lot of statistical data upon which to rely. Next, Sin. Now we also marketability, and you can think of this as the degree of illiquidity that a closely held business has. Generally speaking, if a closely held business owner wakes up today and decides they want to sell their company, even in prior years, it would take 6 months, 12 months, up to 2 years to actually close and get the cash into your hands when you own a closely held business. It is a long, drawn-out process. And there is a lot of risk associated with a sales process that is so drawn out, as is the case with closely held businesses. Public market stock, if you wake up today, decide to sell, you will have a firm price today, and you will have cash in your hands within 3 days. There is little marketability risk right there. That is the definition of marketable stock, cash in 3 days. So over long periods of time, there's been many studies. The studies have gone back decades to look at the difference between public stock and stock that looks like it's public or it's similar, but it cannot be sold quickly. If there's a delay for one reason or another, and you can't sell it quickly. The most prominent of these are restricted stock, lettered stock. They're public stock that cannot be sold for periods of time due to a transaction that has taken place. So they might be a certain number of shares of IBM, but they cannot be sold on the public market as most shares of IBM might. But there are people who will buy those shares at a discount. They will take over the holding period, and they will put themselves in the position of the original stockholder. And this discount that is observed in transactions over many decades gives rise to the theory of how big is that marketability discount. How big is the discount associated with holding the stock and not being able to instantly or almost instantly sell it? Right now, in the short run, you think about the ability of a private company to be sold, to put itself on the market and actually get cash. Right now, marketability could be extremely large. Now, we don't have any data to support that. That is just what our feeling is. That is just what common sense might tell us the lack of marketability is. But we do not have statistical support for changing the marketability wildly. Anything that we did try to do there, it would just be speculation on our part. So we need to be very careful and apply professional judgment how far we're able to push this envelope to take marketability discounts when they're to our advantage. Next slide, Sin. So we have uncertainty of future cash flow. There is a question about the discount rates, and especially industry-to-industry discount risk rates. We also have the issue of marketability or a lack of marketability with all closely held companies right now. This is a very unusual time. Oh, and get back to, I just can't stress enough the importance of the date of the valuation. The date of the valuation is critical to what the actual assumptions and circumstances for the business are upon which the valuation is based. Now, we all hope that this is just a temporary condition. Values will eventually return. There are situations where people can use this to their advantage. What companies now, what they do, how they organize or reorganize themselves, how they position the company, how they position the current ownership to take advantage of this low point in value. As Cindy touched on, there's succession issues. There are estate issues, both federal and New York State or any state. There's personal financial planning issues, and these are all tied together. We've had clients come to us. Cindy alluded to how many tools there are in the toolbox. There are as many solutions as there are companies out there. You should not find that a friend used a certain technique and that exact technique should be applied to you. Everybody's different. The companies are different. The families are different. The individual wants and needs of the individual family members are all different. The desire of past owners vary widely. There is no one-size-fits-all solution here. However, as you study the different options, we try to listen to the situation, understand the situation as best we can, and try to provide you with a few options that might help you solve problems. Ask for help. This is what we do. We're here to help you. We're here to help your organizations, and we're here to help your families. So with that, these are our team members for my group, my valuation group. I work out of Albany. Michael is out of Utica. Dan and Esther are out of Buffalo. Tony Katrup is out of Rochester. Kim is in Syracuse. So we have team members spread across I-90 between Albany and Buffalo. And for the most part, this is what we do. This is what we see every day, and we are here to help.
Thank you, Tony. So, saying seize the opportunity before it's gone, act now. Hope that you picked up some good tips and useful strategies that you can at least consider. And we again thank you for your time. Please be safe.
Thank you all. Be safe.